The vertiginous fall of Sam Bankman-Fried from the heights of founding the FTX crypto exchange to the depths of fraud and money laundering convictions has cast a harsh light on the largely unregulated crypto market. Sam had a great track record arbitraging crypto prices, but was negligent with his position sizing and risk management, did not cut losses when trades failed, and failed to consider liquidity issues. 1. Know your limits. While crypto may be a new market, investors and traders are not immune to the same pitfalls that plague traditional markets. The FTX scandal has thrown into sharp relief the need to be vigilant and make smart, risk-averse decisions in this volatile space. Bankman-Fried's meteoric rise to the top of the crypto industry was one for the ages. From humble beginnings as a Wall Street high-frequency trader, he built his exchange into a mega-unicorn with a valuation in the billions. Along the way, he became an unofficial ambassador for effective altruism, touting the merits of donating money to a wide range of charities. He also made a point to regularly speak with podcasters and explain the philosophy behind his company. The case against him is a cautionary tale of how lofty goals can go bad quickly when they are mismanaged or twisted for illicit purposes. For example, he often promoted a scheme called synthetic margin trading, SMT, to boost returns. This is a form of margin trading that allows you to invest more than you have in your account, potentially multiplying your gains or losses. In reality, SMT is a dangerous game that can lead to massive losses. The best crypto tips will tell you to avoid this technique and never invest more than you can afford to lose. Moreover, you should always check the legitimacy of coins before investing in them. Some scammers create fake coins to siphon funds from unsuspecting investors. It is also important to use reputable wallets such as Ledger, Trezor, or Exodus. Using dodgy wallets can lead to criminals stealing your private keys and taking control of your assets. 2. Don't overtrade. The spectacular collapse of FTX, the once beloved crypto exchange founded by Sam Bankman-Fried, has cast a harsh light on a wild and unregulated market. The vertiginous fall from the dizzying heights of a $32 billion crypto empire to the sobering depths of fraud and money laundering convictions has raised questions about whether blockchain-based currencies can really transform finance or just degenerate into an unregulated swamp of fraud and malfeasance. Bankman-Fried grew his fortune by arbitraging small price differences between assets at high-frequency trading firm Jane Street, where he quickly learned to identify, calculate, and execute low-risk bets. But he was drawn to the promise of cryptocurrencies, which he saw as a way to create wealth and impact on an unprecedented scale. After earning a physics degree from MIT, he started donating half his earnings to animal welfare charities and then created crypto exchange FTX, which became one of the world's largest. As FTX's value skyrocketed, Bankman-Fried invested heavily in influencer marketing, enlisting Tom Brady, Gisele Bündchen, and other famous personalities as brand ambassadors and offering them equity stakes. He also donated to political candidates, hoping to persuade regulators to license his business. As he climbed the ranks of crypto finance, Bankman-Fried realized that if he was to continue growing his fortune, he needed to expand beyond currency trading. So he created hedge fund Alameda Research, which traded other cryptocurrency assets, including margin loans and futures contracts. But as these investments piled up, the fund faced frequent margin calls that forced it to liquidate large positions in volatile markets. That caused massive price swings that were exploited by scammers and could have been avoided if the company had better managed its risk exposure. 3. Stay focused. The recent collapse of crypto exchange FTX and the conviction of its founder, Sam Bankman-Fried, have brought a lot of attention to the cryptocurrency market. While many people want to draw a line under this disaster and move on, the truth is that it's unlikely that crypto is safe from future fraud. But what can we learn from this episode? First, it's important to remember that no one can predict the future. In addition, it's important to stay informed and do your own research before making any investments. It's also important to be aware of FUD and FOMO, as these can often influence markets in negative ways. Lastly, it's important to diversify your portfolio. This will help to minimize risk and maximize potential returns. By investing in a variety of cryptocurrencies, you can ensure that your portfolio will be able to weather any market conditions. When it comes to investing in crypto, it's essential to have a plan and stick to it. It's easy to get caught up in the excitement and hype surrounding cryptocurrencies, but it's important to remain calm and think long-term. By following a plan, staying informed and diversifying your portfolio, you'll be in a better position to achieve your long-term goals. Finally, it's also a good idea to invest in stable coins. These coins are pegged to the value of a fiat currency like the US dollar, which helps to reduce volatility in your portfolio. By investing in stable coins, you can protect your investment against price fluctuations and still reap the benefits of a growing crypto market. By following these tips, you'll be well on your way to crypto success. Good luck! 4. Don't be afraid to lose. Sam Bankman-Fried, or SBF, is a finance and cryptocurrency entrepreneur. He's the co-founder and former CEO of the FTX crypto exchange and the founder of Alameda Research, a crypto trading company. A New York jury found him guilty of wire fraud and conspiracy in 2023. The FTX debacle has brought about many lessons for the industry and consumers alike, but SBF shares some of his own tips for how to avoid getting caught in a crypto-related scandal. Among the most important is not to be afraid to lose, a sentiment that could have saved him from FTX's collapse. After graduating from MIT with a degree in physics, Sam worked at Wall Street high-frequency trading firm Jane Street Capital. In 2019, he founded FTX, one of the largest cryptocurrency derivatives exchanges in the world, with daily trading volumes in the billions. The FTX Foundation allocates 1% of net fees to effective charities and has donated more than $3 million so far. When we interviewed Sam for this episode, he told us about his early days in the crypto scene. He was a bit of an unkempt millennial, playing League of Legends while on important phone calls. But SBF has since grown into a well-regarded and respected figure in the crypto space, with an impressive social impact profile to show for it. He's a big believer in effective altruism and has donated extensively to animal welfare organizations and other high-impact causes. He's also spoken to countless podcasts and is widely regarded as an expert in cryptocurrencies, volatility, and risk management. He joins Tyler to discuss the production function behind his trading success, the importance of having a legal mind when thinking about cryptocurrencies, what Bill Belichick can teach us about being a good leader, whether he's compelled by life extension research, challenges to his Benthamite utilitarianism, and more. 5. Don't be afraid to learn. Sam Bankman-Fried was once a spokesman for effective altruism, the movement that urges people to choose jobs that maximize their impact on the world. He believed he'd earn the most money possible so that he could give it away to charity and help billions of people live better lives. But now the former CEO of FTX has been arrested for fraud after his cryptocurrency exchange collapsed last month. The fallout could tarnish the reputation of crypto's most famous entrepreneur and leave investors who had invested in FTX with nothing but IOUs. The lesson from this saga is clear. Don't put all your eggs in one basket, even if you're an expert investor. Cryptocurrency markets are incredibly volatile, and the best way to protect your assets is by holding them in cold wallets that only you have the keys for. Leaving your assets on an exchange exposes them to risks like hacks and bankruptcy. There are also lessons to be learned about the limits of effective altruism and how it can be manipulated by well-meaning individuals. Many experts have questioned whether the movement is truly capable of changing the world, and the FTX case has only reinforced their concerns. Sam joins Tyler to discuss the FTX case, the secret to his trading success, how Magic the Gathering shaped his approach to business, why he's not a big fan of life extension research, why he thinks Bill Belichick is the greatest manager ever, how much leverage is implicit in stablecoins, why the Bahamas are great for business, and more. This episode is brought to you by the Founders Fund, an early-stage venture capital firm that backs the world's most promising startups. Learn more at www.foundersfund.com.